Good afternoon, fellow traders. Welcome to another webinar in the Blue Sky Forex webinar series. Today's topic is supply and demand, which is one of the most fundamental parts of the market. This is actually the thing that makes the asset prices move. Although it will be relatively straightforward and it will be a quick one, because it is essentially still an easy concept to understand, although really important and completely fundamental. Now, before we continue any further, it would be great if you can just write yes in the question section, whether you can properly hear me and see the first presentation screen. And meanwhile, I will go through the risk disclaimer quickly, so you need to bear with me for a few moments. This material is provided as a general marketing communication for the information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing any indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as Forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, taking into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. Please read the full risk disclosure. So with this out of the way, I would like to introduce you to the agenda for today, which will be a quick introduction. Then we'll take a look at two market types you will come across during your daily trading activities. Then what is supply and demand? Then we'll compare supply and demand and support and resistance. And then some few important things to keep in mind. And of course, at the end, you can ask your questions. So please stay tuned for that as well. You do not have to ask questions specifically about today's topic, about supply and demand. The questions can be general in overall about trading. That's totally fine, and I will do my very best to answer to all of your questions. If any of your questions remain unanswered for any reason at all, then you can also send your questions to webinars@hotforex.com, and they will do their very best to answer to your questions as well. Okay. So I am one of the senior traders here in Blue Sky Forex. We are an educational research and trading group. We teach various different strategies and also provide 24-hour trade support and analysis just to assist you, retail FX traders, to make better and safer trading decisions. So regarding the market types, you will there's a missing slide here for some reason. I'll correct that later. But regarding the market types, first of all, you will have the trending market, which is better for FX traders, because if we attempt to trade along with the currently prevailing trend, then the potential profit gain is much higher than if you would be trading during a ranging market, which is the second market type you will come across. Okay. Now, identifying a properly trending market, however, takes a bit of fundamental understanding and knowledge in order for you to be able to identify the events that have the ability to make the asset price trend significantly one direction for you to properly benefit from. Okay, so you must have some fundamental understanding to identify adequately a properly trending market. And then, as mentioned earlier, then you have the mean reverting or ranging market, which is also profitable depending on the strategy and the trading approach you take. And it's somewhat easier to identify because you will witness the price bouncing between the nearest support and resistance levels and moving sideways. Okay. So supply and demand, regardless of the market type, still exists as this is one of the most fundamental parts of the market. Supply and demand, as mentioned earlier, is exactly the thing that does make the asset prices move. Now, the definition of supply and demand is that the term itself, supply, refers to how much of a certain product, item, or commodity or service suppliers are willing to make available at a particular price. Okay? And demand refers to how much of that product, item, or commodity or service consumers are willing and able to purchase at a particular price. Now, I stress the word able because the consumers need to be able also to acquire the particular product for that particular price. Okay. Now, in other words, supply pertains of how much the producers of product or service are willing to produce and provide to the market with limited amount of resources available. And whereas demand is how much of that product or service the buyers desire to have from the market. Okay, so it is relatively straightforward thus far. But the supply and demand concept is a core component of the economic theory. As mentioned earlier, it is a fundamental part, it's extremely important, and that's what makes the market move. Now, the supply and demand rule states that if the supply of a commodity or any asset is high and the demand is low, it generates excess, which drives the price down. And on the other hand, if the supply of a commodity is low and demand is high, it creates scarcity and that will push the price higher. Okay, so let's say, in other words, let's say you have something widely available in the market, okay, and then the demand is low, so people actually demanding or wanting to purchase that item for that particular price is low. Now, obviously, all the sellers of that commodity or any product or an asset, they want to be the first ones selling it because they want to make business, they want to earn money. Okay. Now, in order to be the first one selling the item, they would need to have the most lucrative price, meaning the lowest price. Okay, because if a buyer comes to the market and wants to get something, they will obviously turn to the seller who has the best price for them, meaning the lowest price, correct? So the sellers, in order to be the first ones selling their product, they are lowering the price. And if there's nobody buying for that price they are offering, then there is either somebody else will make the price lower from theirs in order to be the first one, or they will continue themselves to lower their own price in order to be the first one selling their merchandise, just to be able to make business, right? So that is the reason why that situation drives the prices down, because nobody wants to buy for the price that the sellers are offering. So the sellers are going to lower the price to meet the adequate price for the purchasers to make business with them. Okay. And on the other hand, if the supply is low, then the sellers already know that the product that they are selling, it is relatively scarce on the market, so they can raise their prices because the purchasers who want that item, they are also willing to pay more in order to be the first ones actually acquiring the item. Okay, so this is the reason why the sellers are able to raise the prices, because they do know that the buyers, they are willing to pay the higher price in order to actually acquire the item or commodity or whatever they are selling. Okay, so that's the opposite situation. That is the reason why the prices in this situation or scenario go higher. Okay, and as mentioned earlier multiple times already, that the price of an asset is determined by the interaction of supply and demand on the market. And the above is the example why the prices are moving down or prices are moving up. Now you see an image here on the bottom side of the screen as well, and that situation that depicts a condition called an equilibrium price, and that represents an agreement between the producers and the consumers of the good. And the equilibrium point is the point where the sellers provide a quantity of a goods or an item to the market in the amount equal to the quantity demanded by the consumers. So basically, the sellers of an item produce exactly the correct amount of items that the purchasers desire to have. So it's like a perfect market condition where the buyers and sellers demands and supplies are equal. Okay, but we do know that that's actually really not the case. You will not have this kind of balance on the real world. So the excess demand or excess supply is something that is driving the price of an asset higher or lower because of the um, imbalance. Okay. So in order for you to have the chances of becoming a longer term successful, stable, profitable trader, one of the most important aspects you would need to understand is understanding the supply and demand and really how it works. Some of the topics or fundamental aspects of the market they are optional for you to understand or know to be a longer term successful trader, but supply and demand is one of the core aspects. So that is something that you would need to really understand. But now, just to put it really simply once again, this is a straightforward topic anyway. So basically, supply equals selling and demand equals buying. Okay. So an area of increased supply refers to an area of increased selling pressure. The selling pressure causes an asset price to fall. An increase in demand refers to an area with increased buying pressure, and this area of increased buying pressure causes an asset price to rise. And now the ever-changing balance between the supply and demand is exactly what causes the asset prices to fluctuate over time. Okay. So as supply increases, the market will decline, while an increase in demand will trigger a rally back the other way. So the prices will rise again. Now let's look into supply and demand and support resistance. And a lot of beginner traders they do sometimes think that supply and demand is exactly the same thing as support and resistance. They are really similar in concept, but they are different in certain ways. The supply and demand zones are essentially zones or areas where there is increased buying and selling interest, and where there are this kind of sell and buy orders to be triggered. Support resistance levels are fixed certain price levels where the price is tested and has difficulties breaking through to some extent. There are different types of support resistance levels, which we also, to a certain degree, explain in a separate webinar about support resistance levels specifically. Now, support resistance levels, again, they are a fundamental part of the market, and this is also something that you would really need to understand and read up about and learn about. Okay, no matter what type of trader you are, no matter what type of strategy you are using, supply and demand and support and resistance will always play an important role in the future price movements. So that is the reason why you always need to consider with them. No matter if you're a scalper, no matter if you're a position trader or day trader, these things still apply because they are fundamental core parts of the market. Okay. Now here, maybe not the best examples. Perhaps these zones could be made a bit wider even, because you will the price does find some buying and selling pressure on a bit wider area. I need to update these a bit. But these basically depict data supply and demand zone. Now, along with supply and demand zones, you may want to take a look at the trading volume as well. Because if you're dealing with supply and demand zone, you will have buy and sell orders, an increased amount of them in that zone, in that area. So whenever the price reaches that area, obviously these buy or sell orders will be triggered. That means that the trading volume in during those areas will also increase. Okay, so volume and monitoring the volume will help you to some degree identify the supply and demand zones, so you will know a bit better what is currently going on. Okay. And here we have just a one of the versions of the support resistance level. This is a horizontal support resistance level, drawn manually considering the price activity from the past. The support resistance levels, they are fixed price levels where the price has difficulties breaking. And for example, just to bring a very easy example, these kind of round numbers like 1.0000, the more zeros, the stronger the psychology of the traders around that level. They will see more zeros. They do expect that this would be a stronger support or resistance level for the price. So round numbers is one of them, definitely. And you have resistance level types that you can also look into. So that is the core difference between them. The supply and demand zones, they are zones where there are more buying and selling pressure. You will see the price picking up previously initiated orders. Okay, but the support resistance levels, the volume around these points, around these levels, may remain the same completely. It doesn't immediately mean that there is increased volume, unlike with supply and demand zones, right? Sorry if I talk a bit quietly. I did have a surgery last week, so it's a bit painful for me to talk. So you need to bear with me for a few moments, and that is the reason why it will be straightforward and a not very long webinar this week. Hope next week will be a bit better. So sorry for that. Now, there are a few things that you would need to keep in mind when you think about the supply and demand zones. Okay, there is a certain um, zone, which is the accumulation zone, where there are a lot of buy orders being triggered and accumulated inside the demand zone before driving the price in a certain direction. Now, this relates to the pre-bullish trend, where the price does stay in the accumulation zone until the big players have accumulated their positions, and afterwards the price is driven higher. Now, the big players in the market, if they, let's say, if they set up one single full order that they desire, that is their goal, their target, onto the market, that may lead to an immediate rally, because if they swamp the market with their full orders, it's a high chance that an immediate rally will start and they would not be able to get the complete fill. So that will reduce their profits. So if they set up their orders in that accumulation zone bit by bit, then it is higher. There is higher chance that they will be able to get all of their desired targets fulfilled in their orders. The target orders fulfilled, and then the price will be driven higher. Okay, so they cannot just throw everything out there and hope for the best, because that will definitely result in lower profits for them. So that is an accumulation zone where the big ones with a lot of cash are accumulating their positions together. Okay. Now, another thing to keep in mind is that if you witness a lot of really strong back and forth fluctuations and a lot of candle wicks on both sides, they often cancel this kind of supply zones for future traders, because the investors basically just lose interest, because they may perhaps witness that the market is too hectic for them to risk opening additional positions. Okay, so that will kind of cancel out the supply zone. The good supply zones, they are somewhat narrow and do not hold for too long, because a short accumulation zone also works better for re-entries when you are witnessing a pullback. Okay, so if you pull back during a pullback, the price re-enters re-enters the supply zone, then there may be additional interest and additional orders already being initiated. So there is additional orders that are being picked up. Okay. So when you witness the price picking up these orders during the demand zone, that eventually will break out, right, and probably starts trending. Now, a strong imbalance between the buyers and sellers, of course, may lead to a strong and explosive price movements or breakouts, especially if the price was in a zone for a very brief time. Okay. And as a rule of thumb, you can keep in mind that the stronger the breakout, the better the demand zone, for example, and the more open interest will usually still exist in that zone. Okay, especially if the prices time spent in that zone was relatively short. Now, it is quite similar to the support resistance levels. So each time a price revisits a supply zone, for example, more and more previously unfilled orders are filled and the level is weakened continuously. Eventually, there are no sell orders left to um, trigger, and the zone will break. And there is also strategies out there that the institutional traders, the big players, will use to trap the amateur traders on the wrong side of the market. And one of these strategies are called the spring, and after which the big players absorb all the amateur sell orders and then drive the price higher. Okay, so try not to get caught on the wrong side of the market, although there is really not much you can do to influence that. You just have to be really vigilant and make sure that you have your money management and risk management techniques properly in place. Okay. Now, a few things about dangers when you are trading FX. First and foremost, try to refrain from using any automated systems or bots or robots to place trades on behalf of you. Many of them are designed to generate losses on your trading account, so please be extremely careful. If you want to try out any of those, then please do so on a demo account. If you witness your account balance over a longer period of time, raising without large drawdowns and doing so steadily, then you can think about whether you want to set it up on a live account or not. And if you do so, please use low lot sizes to trade as safely as possible. The next point I want to make is, which is sad but true, only 5% of retail FX traders make money in FX in the long term. So one of the reasons, or the main reason behind that, is our own brains, our own body, our own psychology. So for example, if you are on a winning streak, okay, so you win multiple trades in a row, you made some profit, then your body, your brain is releasing chemicals like dopamine and adrenaline. Now, the combination of these two, they make you feel good. Okay, they make you feel good, and your body and yourself, you get addicted to that good feeling. You want to feel that good feeling more. Okay, that's a completely normal behavior. There's really not much you can do about this. This is how our body works and how our body reacts. That's normal. But now, with that, the desire to get that good feeling again, you may end up in a situation where you find yourself over trading. And when you are already in that consistent euphoria, then you will eventually stop analyzing the asset prices properly and start making mistakes. Now, with making mistakes, you may lose part of the profits you made, all of the profits, and end up break even for the session, or even generate some losses on top of that. Now, another situation will happen where your body releases different kinds of chemicals and hormones in your body, and you are ultimately a chemical cocktail with all different, filled with all different kinds of chemicals. Okay, and the situation or condition called an amygdala hijack will eventually happen, where your basic brain takes over and you go into a revenge trading mode. And again, with you being a chemical cocktail, you additionally prevent yourself from making the right decisions and conducting proper price analysis. So you will start damaging your account even more in the desire of making back the previously lost money. Okay. Now this is extremely dangerous situation already because you are inadequate for trading and you will cause even further damage to your account or even completely destroy it. So that is the reason why only 5% of retail FX traders make money in FX in the long run. Now, in order to prevent Actually, sorry, you cannot prevent this these chemicals or hormones to be released in your body unless you do some biological alternation, which most likely isn't going to happen. Um, you can prevent yourself from damaging your account if you do have proper money management and risk management in place. There are two rules that we here in our team use very extensively. The first rule is the 1% rule, and then we have the 5% rule. Okay, let me explain what this is. So, the 1% rule means that no single trade should be able to cause you more loss than 1% of your total account balance. Okay, so one more time. And no single trade should be able to cause you more loss than 1% of your total account balance. Right? And then the 5% rule is that if during one single trading session you lose 5% of your total account balance, then you will simply shut down your tools and walk away. Okay? So once again, if during one single trading session you lose 5% of your total account balance, then you will shut down your tools and walk away. Now, if you do employ these two rules, then these will definitely help you remain in the game, so to speak, or remain trading for a longer periods of time. Because the longer you remain trading, the longer you are able to engage the industry and the market, the more experience you will gain. And of course, the more experience you will gain, the better you will become, and the better you will become, the more chances you will have to become a longer term successful, stable, profitable trader. Okay, and that is kind of the goal that we are all trying to reach or achieve. What could be better than being able to work from home, spending some hours a day uh, conducting a few trades and making stable, steady income, right? So that's kind of the dream I believe that most people have when they start in this industry. That is kind of the goal they are trying to achieve. And this is also one of the advertisement tactics that the brokers or signal providers have used in the past. Maybe you've heard the expression or a sentence that, become rich with the click of a button or something like that. I do remember there being one broker in the past advertising themselves like that, just to gain new traders, to make deposits on their platform, etc., etc. Um, Quite unethical to my mind, but what can you do? And a lot of people, of course, they are lured into this industry by this type of advertisement. Um, you can't blame the advertisement because technically it is true. It can be done. You push a few buttons and you will be able to become rich if you push the right buttons and make the right decisions, right? But we all know that trading is not that simple. That's why you are also here today. Um, I believe if you do employ the correct risk management techniques, and if you learn consistently new things every day and be persistent with your learning and with your trading, and try to let the least amount of emotions into your trading, none if possible, then you do have definitely high chances of being able to overcome all the quirks of the industry and all these different kinds of market conditions and black swan events and so on, so on. There is definitely a chance, a possibility, and the more you learn, the higher the chances, of course. So keep that in mind. And last but not least, but only 5% of signal services and signal rooms are legitimate. So if you want to engage with them, please be extremely careful. Ask for a proper performance record and audit trail. And better yet, if you can ask for any experience from previous longer term users to see if they have been able to grow their account capital over longer periods of time without large drawdowns steadily. If so, then you may go ahead and perhaps try it out yourself as well. And if you do witness the same thing, then then go ahead and set it up on a demo account perhaps. And if your demo account also keeps behaving the same way, increasing steadily over longer periods of time without large drawdowns, then you can really decide if you want to set it up on a live account. And if you do so, please use low lot sizes to trade as safely as possible. Okay, so that is it for today's webinar. As said, it is really straightforward. Um, it is time for questions. I'll open up the questions section. If there is any question that I'm not uh, answering on this webinar, then please do send an email to webinars@hotforex.com, and they will also do their best to answer to your webinars. Sorry, questions. And once again, to mention that you do not have to specifically ask questions about supply and demand. Your questions can be about trading in overall, and I will do my very best to answer to all of them. Emeka Christopher is asking, demand supply, is it a trading strategy? Okay, it's actually a really, really good question because um, in a lot of places, the knowledge about supply and demand is presented as a trading strategy. That's true, but supply and demand itself is not really a trading strategy. A trading strategy, first of all, consists of so much more than a simple technical condition between two indicators. Um, that's really not the case. A strategy consists of your money and risk management techniques, the session selection, the asset selection, and all these bits and pieces put together, along with technical conditions between some indicators, if you may. That is a strategy, the way you approach your trading and then the method you use to reach your goals. So that is a trading strategy. Now, supply and demand is not a trading strategy per se, because it is simply a core concept, a core fundamental part of the market. Supply and demand works all over the world in that sense, in heavy industry, in food industry, in medicine industry, in everywhere. You see, supply and demand is everywhere. Okay, and the imbalance between the supply and demand is exactly what makes the asset price fluctuate up and down. Okay, so it's a core fundamental aspect and core fundamental part of the market. It's not really strategy separately. Now, how you utilize supply and demand concept may be translated into a strategy. If there's a certain way you approach supply and demand zones and place your trades based of certain conditions or certain situations that you can visually analyze, um, then that can be called a strategy, yes. Umama, first of all, really appreciate your concern. I think thank you for your words. Uma, if I pronounce your name incorrectly, I apologize. And the question is, please, does supply and demand, is it workable on all time frames? Yes, for sure. As supply and demand, as I mentioned earlier, is a core part of the market, core concept, then you can analyze, of course, the supply and demand on all time frames. There are supply and demand zones on all time frames as well. So it's not really time frame dependent or specific. Just if you analyze supply and demand zones, let's say on an hourly chart, um, it might be fundamentally a bit different than if you analyze the supply and demand zone on a weekly chart. Okay, because you really need to understand the mentality of the traders when they are analyzing the market conditions on different time frame charts. Okay, if you analyze everything on a weekly chart, then you obviously have to think greater. You have to think of the bigger picture, what's actually going on in that economy of the underlying asset, for example. You will need to think about a bit more fundamentally in that case. If you analyze supply and demand zones on an hourly chart as a comparison, then you may ignore some bigger picture fundamental aspects of the underlying asset, for example. So that's kind of the difference. While we wait for more questions, if they come in, I would like to let you know that I have uploaded the PDF version of today's topic into the handout section. So if you open up the handout section, you'll find the supply and demand trading.pdf. And if you click there, a web browser will open that will allow you to download the a PDF version of the webinar topic to your computer for review later on. And also all our webinars, they are recorded and they are uploaded to the past webinar section, which is something you can find when you log into your HotForex account. Go to the education section that you'll find at the bottom part of the page. And in the education section, you'll find the link that leads you to the past webinars. And there you will find um, the recordings of all the past webinars, and I do highly recommend taking an hour a day to go through one of the topics, and I'm sure you'll find a lot of useful and interesting information. Okay, Precious is asking, a good day, please. How can I set my break even? Okay, I'm not 100% sure I understand your question, but if I do understand your question correctly, you are looking to know um, how to modify your stop loss in MetaTrader 4 to the break-even level. if the trade has made some profits, I presume. If that is the case, and then in the MetaTrader 4, let's say you have your trade entry line. Okay, you see a trade entry line on the chart in the MetaTrader 4, and the price has, let's say you're in a long trade and the price has risen, and the trade is in a profit area. Okay, so basically what you can do, first of all, you can, with your mouse cursor, you can grab your trade entry line and lift it upwards and then release. If you do that, it will create a take profit level. Okay. If you grab the line and drop it below that line, it will create a stop loss level. Okay. And then you see the stop loss level and the take profit level as lines separately from your trade entry. Now, you are able to also modify and adjust your take profit levels and your stop loss levels by grabbing the line and just dragging them up or down. So in this case, you can simply grab your stop loss line and raise it to your trade entry point or just a little bit above it. Okay. So in this scenario, whenever the price comes back down near your trade entry, you will already have a stop loss level waiting there, and you will exit the trade as when that stop loss level is hit. So it's simply a matter of dragging the line that isn't initially visible as your trade entry line. Just drag it up or down. It will create a stop loss or take profit level, and then you can simply drag your stop loss level to the break even point. Jesse is asking, do you know what's QML structured trading? I haven't really researched into that too much, but it should be a reversal trading pattern, reversal trading system where there are a lot of different setups. But as I haven't researched into this topic or this method, then I really cannot comment too much about it. So any further questions about this QML, um, I most likely am unable to adequately answer at this point. I'm just giving you a heads up. Amanze is asking a great question. How do I identify a strong support and resistance as well as a weak support resistance levels? This is a very valid question that definitely a lot of people are asking on the forums and so on, from me personally as well. And most likely I will disappoint you a bit because there's really no definitive answer, one answer or one method or system that you can really rely on in terms of that. But all you have to really do is analyze how the price has been behaving around that price level in the past. When was the last time the price was at that level? How did it behave around that level? Was that level broken immediately, or was that level preventing further price movements? When it was preventing further price movements, how many times the price retested that level before it broke it or before it was repelled again? Okay. Now, all these small bits and pieces and all these details put together will help you to realize what the price may be doing right now around that same support and resistance level. Now there are a few things that you can still keep in mind when you think about support resistance levels. For example, let's talk about round numbers again. Okay, now round numbers are one of the strongest support resistance levels there. So let's say if Euro USD went to 1.00000 right now, I can already tell you that it will serve as an extremely strong support resistance level because it is a very round number. Okay, so it's a psychological support resistance level, and it will serve um, as a very strong point where the price will most likely not be able to pierce it for quite a bit of time. Okay, so if you keep in mind these kind of aspects, these kind of pivot points, the previous day highs and lows, um, these are the first things to keep in mind if you think about the strength of support resistance levels and support resistance levels in overall. But it really depends or comes down to your price analysis and the historical price behavior analysis around those support resistance levels. Okay, there's really a lot to talk about the support resistance levels. And if you really start thinking about one certain condition um, that you want to rely on, then think twice, because the price can behave in extremely weird ways around even the strongest support resistance levels that you may never have expected. Okay, so there is no one single rule that you can follow. It's just really about your past price analysis and the current price analysis, what the price is doing right now around that support resistance level. Okay, a follow-up question from Amanza. With the simple definition, explain what is a psychological level in trading. Sure. Well, first of all, if we start talking about psychological levels in trading, you have to realize that we are humans, right? And the big players, although they are also using algorithmic bots and robots, whatnot, to place trades on behalf of them, machine learning, etc., that is next level. But there are still humans placing big trades as well and moving the markets. Okay, managing big sums of money and amounts, placing trades with those, and actually moving the assets. Okay, so as humans are behind trading, then these humans, these traders' psychology comes into play when they are making their decisions. Okay, so that is the basic part to realize and understand, because they are the same way. If you are placing a trade and if you lose it, then you will feel differently psychologically and emotionally, and that different feeling will um, translate into you making certain next decisions or next activities or actions. Okay, so if we talk about psychological levels in terms of support and resistance, right? So if a trader sees that the price is dropping throughout multiple different price levels and numbers, and now reaches 1.0000, it is psychologically um, highly likely that the trader or person will expect that this 1.000 level will prevent the price from moving further, because they are also thinking about support resistance levels, and they are thinking about that other traders are thinking it like they are. Okay, so this kind of psychological union and logical thinking will actually manifest this support and resistance level to be relatively strong around that round number level, the psychological support resistance. Okay, so I'm not sure if what I was thinking actually came out right, and if you completely understood it, but it's kind of psychological thinking about trading, and then and the union will definitely make these support resistance levels exist. Okay, so these round numbers, for example, they're already visually identifiable as round numbers and potential strong support resistance levels because people think quite similarly in that sense. There's really no easier way, I think, to put it, but I'll try to think of perhaps an easier written down definition for the next time when we talk about support resistance levels in the support resistance webinar. Amanze is also asking what currency or asset serves as safe haven during recession. Well, there is one straightforward answer to that. I'm sure that most of you have come across this as well, which is considered to be a safe haven asset, and that is gold. Okay, and gold is something that people can buy physically. They can buy, options, futures, and so on. I also personally own physical gold, just for the kind of the apocalypse scenario where all the currencies potentially will fail. Nobody wants or has any desire for paper, but in that scenario, gold will still reserve its value. Okay, if you put it to these kind of extreme scenarios and think like this, then you will already know what may have value even during a recession time. Now, these kind of precious metals, especially gold, they are considered as safe haven assets during a recession time. So it is likely that if right now we have euro that may fail at some point, we may have the dollar. A lot of people are talking about that the dollar in near future, in the next 5 or 10 years, in an extreme case, in a black swan event, may fail totally. And in this kind of scenarios, if that actually happens, which is of course a very, very severe financial situation in the world in overall, then gold may still prevail. Okay, because gold is being used in industries, in different industries, and quite a lot. People still love jewelry. It's a beautiful metal, right? People love jewelry, so it would still be desired even if that paper that we have in our hands or digital money will fail, then gold will most likely still prevail. So we have now hit the 1 hour mark, and I'm going to wrap this webinar up today. I would really like to thank you for all of your questions and would like to thank you for attending today's webinar. It has been my pleasure to be the host, and as always, trade safe, stay safe, and good luck, everybody. We'll see you next week. Goodbye.